I'm not sure if this is capitulation per se or just sort of hate along with being ignored, relatively speaking. And oil and gas globally is enormous relative to the overall global economy. And I'd say the amount of attention being paid to it is quite low, the amount of interest is quite low, and the bias for several years now has been to sell oil rather than to buy oil. So yeah, I think it's a compelling time.
Hello everyone and welcome to another edition of CEO and Market Expert Interviews. I'm your host Lucian, most of you know me as Triangle Investor from social media. Today we are talking about oil and gas and my guest is quite familiar with that topic. He's a known name in the sector, Chief Investment Officer and founder of Bisonn Interests, Mr. Josh Young. Welcome to my show, sir.
Thanks for having me, Lucian.
Thank you for coming once again. Let's start with a broad question. Your helicopter view of the oil and gas sector. What are the most important things average investors should know about the current state of oil and gas sector? I know it's a big question, but if you can answer it, let's say in 3 or 4 minutes, something like that.
Okay, so I think the biggest, most important point is that oil demand has grown by about 1% a year for the last 40 years. And before that, it grew a little faster. And so there's always headlines during downturns of various commodities and various industries threatening the end of those industries. And I think it's important to be able to back up and say, hey, if there's an argument that oil demand is growing by less than 1% a year, the burden of proof on that should be very heavily in the place of the group arguing that demand will not rise rather than the group that argues that demand will rise in this long-term trend. So I think that's the most important argument and most important, I think, fundamental starting point for analyzing the oil and gas industry, because right now we're seeing global oil inventories decline despite a consensus for global oil inventory increases. And inventories matter because ultimately price is set by supply and demand matching, and it's the way for the market to set price. And inventories make that slightly complicated because you can store commodities for periods of time. And so this decline in inventories tells you that the market is relatively undersupplied, and at the same time we have these headlines talking about an oversupply, talking about risks and uncertainties, talking about demand maybe not following its long-term trend. And so I think just very simply, very high level, demand continues to grow and sentiment continues to be negative, but inventories are falling. And I think that's sort of the super high level setup. Negative sentiment, strong fundamentals, and demand continuing on its long-term trend.
Okay, Josh, what numbers are we talking here when it comes to decline of the inventory? Is that a big number? Can you give me some color on that?
Yeah, so the latest, this just came out on social media in the last week or so, and got to see it. Actually, I got to meet with the OPEC folks in Vienna at the end of February, which was fascinating, and they have several different sources that corroborated this. There was roughly a decline of about 1 million barrels a day from the start of this year, and it looks like it might have been a little higher decline in January and a little lower decline than that in February.
Pretty big numbers, I would say. First of all, disclaimer, I'm not an expert in oil. My viewers know that I'm more of a uranium, precious metals, copper guy, so if I ask a question that doesn't make too much sense, please let me know. But I believe I will do just fine. Josh, as I said, I'm a speculator, and I personally I like the unloved sectors, or better to say hated sectors, in which the retail has showed capitulation and where the sentiment is very, very low. So can we say that oil and gas sector are now in the capitulation mode, and that I mean, is it a good time to enter or re-enter the sector?
Yeah, I'm not sure if this is capitulation per se or just sort of hate along with um, being ignored, relatively speaking. And oil and gas globally is enormous relative to the overall global economy. And I'd say the amount of attention being paid to it is quite low, the amount of interest is quite low, and the bias for several years now has been to sell oil rather than to buy oil. So yeah, I think it's a compelling time. And then I was chatting with a retired oil trader from one of the very big oil trading firms this morning, and he was telling me how he was excited that Exxon and Chevron stock were up for the year and were relatively outperforming versus the market. And I actually think that's a good signal to want to go buy small caps, because to me that's not a signal that money's going into oil and gas. It's a signal that the money that's going into oil and gas is hiding and going to the largest, most liquid names. And at the same time, you've seen actually the smaller caps sell off. And I think it's the market signaling risk off in oil and gas, and to me that's a signal to go buy more.
Excellent. Just quick return to the inventories. I read, I believe yesterday or maybe the day after, that Goldman Sachs expects global oil inventories to rise actually. So despite the recent non-consensus declines, do you believe that they are wrong?
Yeah, so they expected oil inventories to rise in Q1, and yet they've fallen. So did the EIA and the IEA and many other forecasters. And so far, they've been wrong. And I think the data that they're looking at and the signals for this decline, I think, are giving them bad indications. And I think it's likely that they're going to continue to be wrong this year. And we've had this weird phenomenon happen with these forecasts where it's easier to pick on the big agencies, so the EIA and the IEA, but they've persistently been bearish in the last 3 years or so, and they've forecast very large inventory increases, and those haven't happened in the last few years. And so when they forecast these inventory increases for 2025 and beyond, and then the banks sort of follow that in a sort of consensus building and sort of consensus. They'll vary very slightly from that consensus. I think there's just a reasonable expectation that whatever the calculation flaws and analysis flaws that are going into these wrong forecasts don't seem to have been fixed. And so I would expect inventories to do better than Goldman and JP Morgan and the EIA and the IEA are forecasting, absent some real significant change in the global economy or some other thing that's hard to observe right now happening that really sort of shifts the balance.
Yeah, I want to touch the oil price today we have. Why is actually the oil price under pressure? What are the main reasons we are seeing the weakness in the price?
Yeah, I mean, the joke about that is that there's more sellers than buyers, so that's what drives the market price. It is a very odd thing, again, when you look at it, because price is set by supply and demand, and it's supposed to be the spot where it meets, and then inventories are a sort of cushion for that, where you can, if you were in a tight spot right now, but you expected things to be way looser 6 months from now, you might draw on inventories but not really increase price. But we've seen that for a few years now, and so I think the best guess is that people are persistently bearish based on these forecasts that have been wrong so far. And then you're seeing a willingness to sell down physical inventories and a willingness to sell down paper barrels via the futures market. And so I think it's purely sentiment driven situation. And the one other thing I think that's worth noting is that historically the oil market the price was set based on the current supply demand balance. But because of the proliferation of oil futures and options and other sorts of financial instruments, it appears that the market has shifted to be forward looking. And I think that shift is noteworthy. I don't think people talk about it nearly enough, and I think it better explains why the price would be low even though inventories are falling, not rising.
Very good point. Josh, what catalyst in the short term could push the price higher from these levels? And another way around, what could trigger more downward pressure?
So I think when you look at the positioning in the futures market, we're not at the lowest level in the last 20 years, but we're pretty close. And so, especially when you consider all of the sort of derivatives and stuff that isn't really counted in the commitment of traders data, it looks like we're pretty low from a positioning perspective. It could always get worse, but historically, when you've gotten down to levels like this, you've seen prices rise, not fall. And then from a physical perspective, there is a question of when do you hit the tank bottoms? And not necessarily across all of the storage facilities and all of the pipelines and so on, but there is a necessary minimum working capital number. And as you get to low inventory levels, you're going to see in at least certain basins and trading hubs and so on, you're going to see inventories get to uncomfortably low levels and you'll see things break. And so from a trade perspective, you'll see contracts not fulfilled, you'll see failure to deliver on cargoes and so on. And we're not quite there yet, but if we had the current trajectory continue, along with SPR builds rather than SPR declines, I think you could be there later this year. And so if inventories continue to draw, which it looks like we're on trend to, and very recently we had another weekly draw, and we're seeing refineries start to pick up and refining margins start to recover. If we see a big physical draw continue, then I think that could be a catalyst for a pretty significant move up. And in terms of moving down, it's always possible for futures prices to just, whomever's selling this stuff or shorting it could just keep selling it and keep shorting it for the meantime.
Yeah, you mentioned margins. How are profit margins looking at today's price for the largest companies like Exxon, Chevron, Shell? How are those margins looking?
Yeah, they're pretty thin. So when I mentioned margins, I was referring to refining margins, so the crack spread. And no, I understand, but I just wanted to differentiate. So actually, for those producers, they typically also they're integrated, they own the refining too. So their profitability went from actually negative late last year, where refining margins got down to well below $20 a barrel, now closer to 24 or so in the U.S. And so on a 3-2-1 crack spread. And so that's a decent level, and those producers those integrateds are starting to make a little money. From a total cost perspective, though, I think these companies are not making that much money at just over $65 WTI oil. They like to talk about how they break even at 40 or 35 or 45, but when you look at their total obligations, sorry, go ahead.
Yeah, that's thin. Yeah, agreed.
Yeah, when you look at their total obligations, they struggle with their buyback commitments and their dividends and their long-term oriented investments. And when you fully burden everything, the Federal Reserve, they do this regular. The Dallas Fed does a regular study of break-evens in different basins and stuff. And I don't think that really fully covers the full cost, including buying inventory and the other full cycle. Yeah, I think these companies really struggle below, let's say, $75 oil.
Mm-hmm, mm-hmm. I saw Reuters featured your insights on how rising drilling costs are prompting producers to scale back capital spending, contrasting with Trump's "drill, baby, drill" agenda. I want to touch on the costs. How much are the costs influenced by the rising inflation and the inflation numbers?
That's a great question. We were just chatting before we got on about the recent Federal Reserve statement, and I think there's a lot of confusion, a lot of complexity there. I think it's more of a question of how much costs rose a couple of years ago and how sticky those costs have been. And so the COVID era, depression in activity, and then the post-COVID resurgence really reset prices higher for drilling and for labor. And so I think those levels are quite high, and they were reset by a move to in oil over $100 a barrel. And so it was sort of elevator up and then stairs down in terms of costs. And I think we're still at a level where costs are quite high relative to prices. And then that doesn't even factor in the replacement cost for the inventory, where when you look at the valuations that Exxon and Chevron just paid for Pioneer and Hess, respectively, and the Hess one hasn't closed yet, but it looks like it's likely to close. They're paying essentially for these assets. They're essentially like to get their stated return, they're paying essentially $100 for a barrel, plus or minus a little. And so they really need higher prices in order to get payback and then to earn the equity return that they target for their investments. So they can say, oh, we're break even at 30 or 40 or whatever, but the reality is they're acting as if prices are going much higher, and they really need that for some of these deals to make sense.
Understood. On the natural gas side, you are more bullish, let's say, than oil side. I mean, the LNG exports recently hitting a record daily highs and gas prices near 3-year highs. So it's a little bit different story. You agree on that?
Yeah, I mean, I think we're bullish on oil and on natural gas. And I think the weird thing for us is that being bullish on gas is sort of consensus. And so we have a consensus view for once, which is that we're bullish gas, like I think the rest of the market is for the most part. And then the one thing I think people are missing is these LNG facilities get built faster and more efficiently than they were before because they're modular. And so this move towards these modular export facilities means that more of them are going to come on, and they're going to export more than people are expecting. And if you look at what the producers are saying in terms of what price they need, and then you look at their financials, and the financials maybe imply that they need an even higher price than what they're saying, you're going to need much higher prices in order to supply these facilities. And the facilities are getting built with specific end users contracting for portions of those cargoes. And so I think there's a really high probability that they get built and they get used. And that means that the price needs to clear even higher than the sort of bullish consensus is expecting.
Mm-hmm. When it comes to the natural gas stocks, what profile of companies are you suggesting here?
So I think that the tough part is because the consensus is bullish, normally we would go for sort of the dry gas, larger producers that are the lowest cost, break even, to be able to have a large margin of safety. The problem is that those companies have, in my view, very little margin of safety because they price at such a high valuation and such a low free cash flow yield at the current forward curve, which is elevated versus the current spot price. So that's a tough way to play it. My favorite way is through the sort of mixed producers that also produce a little oil and a lot of natural gas liquids. And higher gas prices, I think, are going to drag natural gas liquids prices higher too, especially as you see likely more ethane rejection as you just need more gas into these LNG streams and into the power plants and so on. And so I think those companies could get sort of a double bump of both higher natural gas revenue and dramatic improvement in margins on the natural gas liquids that they're producing. And so that's my way of playing it. And the wild thing is some of these producers are trading down with oil, and even though their revenue and cash flow is driven to a large extent by natural gas, both because of their gas and natural gas liquids, so you have this very big disconnect. And even though the consensus is bullish, I think people are really afraid to get their gas exposure through these liquids-rich producers, and I think that's where the most upside is, and actually some of the least risk, because the values, they're only pricing in $2 or $3 natural gas, where the current price is over $4, and the forward curve says you might get to $5.
Yeah. M&A. Do you see more M&A in 2025? And if yes, in which segments of gas and oil sector?
Yeah, so I think there will be a lot of M&A. I think it's hard for there to be more than we saw with Exxon buying Pioneer and Chevron buying Hess. I mean, these were very, very big deals. And so I think we'll see a number of sort of medium-sized deals. We already saw Double Eagle get bought by Diamondback, which was a great deal and very high valuation, but very good assets, and good to see sort of that. Or we have a theory that basically all or almost all of the small public and private producers in the Permian are going to get bought, at least the ones that are willing to sell. And so that's moving towards that trajectory. The number of private equity backed producers of any size has diminished rapidly. The number of small publics focused on the Permian has fallen. So I think that'll continue, and I think you'll see that consolidation continue in other basins. We had a small producer we're invested in get bought in North Dakota. And I think we'll see Eagleford consolidation, and I think you'll even see some buyouts in some earlier stage plays, like in the oily Utica and in some of the Oklahoma plays. I guess I'd rather not name specifics, but if you look sort of outside of the scoop and stack, I think you'll see a lot of consolidation.
Okay, the part of the interview that usually my guests hate, and that is price prediction or price guess, I would say. So we are recording this on March 19. So next year, March 19, 2026, your guess, your estimate, where will the price of oil and natural gas will be by this time next year?
Yeah, I can see why people don't like this. Yeah, I mean, look, I think that oil should be higher by then. I think there's a chance of it going way higher, and there's a chance that the market pressures still haven't cleared. But I think it would be reasonable to expect oil over $80 WTI, which is a $20 plus deviation from what the forward curve is saying for oil. And then for natural gas, I think we have a good shot. I mean, it sort of gets into shoulder season, but I think we have a good shot at $5 an MCF going into shoulder season next year this time. Which I don't know which of the two of those is more of a radical prediction, but I'm pretty excited.
Of course. Is there any other commodities that you are bullish on besides those two?
Yeah, I mean, like I was saying, the natural gas liquids I think are fascinating. I think there's a shot, and this is going to sound a little wonky, but the local realized prices for ethane and propane in West Texas and parts of Canada and even parts of Oklahoma, these prices a year ago were near zero. You were getting ethane rejection where you were better off paying to stick your ethane into the gas stream, paying a penalty and sort of keeping it there. I think there's actually room for ethane to get a real price, and we're getting a little bit of a price here, but you could see the price go up 50+% for ethane in terms of what producers realize, and maybe 30% plus for propane. So I think it's sort of a interesting spot where people really aren't paying much attention, and where there's room for potential price improvements much higher than for oil or for headline natural gas.
My apologies, Josh. This is my last question. Trump tariffs. How do you see that? How do you see that influencing the market?
I think that everyone's sort of surprised that Trump is as serious about these tariffs on U.S. allies and trading partners like Canada and Mexico and Europe. And it does appear that there's been some willingness to defer the tariffs. So in an upside case, those deferrals become more permanent, and we end up with modifications to free trade deals that reduce tariffs on both sides of the border, of these borders, and we end up in a better trade environment, which would be extremely bullish for oil. And then there's going to be an issue with China, but I think that's well telegraphed. And frankly, I think China might be more ready for it than the U.S. So yeah. I don't think that'll impact oil demand too much. The downside case is scary, right? I think you could see a period of lower economic growth and disruption from tariffs. That being said, there would also be trade flow issues with oil. And so I think the oil downside impact from tariffs from here at, we're at 66 or so dollars a barrel right now for WTI. I think that there's maybe a few dollar potential downside to oil from here. I think a lot of that downside's priced in. And it wouldn't be fun, but I think after a few months hopefully it would get resolved, and I think then there would be significant upside because of the drilling deferrals and other sort of reduced capital activity that comes with prices being anywhere close to where they are right now.
That was Josh Young, Chief Investment Officer and founder at Bisonn Interests. Josh, thank you for coming to my show. I really enjoyed this chat, learned a lot, and I hope to host you again sometime soon.
Thanks a lot. I appreciate you having me on.